Vale has a price to earnings ratio of 4.3. That means it is very cheap. For every dollar it earns, we have to pay only $4.30. But there is a reason for such a low price, and we will find out what it is during our analysis of this Brazilian corporation that is currently the largest producer of iron ore and nickel in the world. So let's start with a little bit of history. If you were to invest $1,000 in Vale 10 years ago, you could buy around 75.2 shares, and today they would be worth around $1,033. So in 10 years you would gain only 3.3%. That is not a lot, but let's remember about the dividends. For the 10 years you would receive $579 as dividends, and that is without reinvesting them. So if we add the current value of shares and the dividends, we would have $1,612, and 61.2% gain in 10 years looks much better. Maybe not incredible, but really decent. Individual insiders, that is an X. 0% of the company is owned by individual insiders, and we are looking for the management to own at least 2% of the company, because if they put their own money on the line, it is much more probable that they will take good care of it. It is also worth noting that Brazilian government owns 12 golden shares of Vale, and these give the government veto powers over certain decisions. And the government used its influence in the past to change the management and push the company in a certain direction. So this is something to remember. And since there are no individual insiders, then of course they are not buying. And the super investors, do they own this company? That is a check. We see two super investors, and they are Howard Marks and Bill Miller. And are they buying right now? That is a check. Howard Marks bought 324,000 shares, and Bill Miller sold 104,000 shares in the last quarter of this year. Return on invested capital, that is an X at 6.6% 10-year median returns. And we want to see this number higher than 10%, so that is not perfect. And free cash flow growth, that is a check at 22.2% 10-year compound annual growth rate. And just as with return on invested capital, we would like to see this number higher than 10%. So that is a beautiful result. And what do we know about net profit margin? It is a check at 21.7%, and the industry average is 14.7%, so they have a healthy advantage over most of their competitors. And now let's take a look at share buyback. It is a check. In the last 10 years they bought back 9.9% of their shares. So without investing any extra money, long-term investors became owners of a larger part of this company. And that is very nice. And the debt, it is a check. It would take just under 1.5 years to pay the long-term debt with a 5-year average free cash flow. With a current one, it would take only 2.5 years. And why I used a 5-year average free cash flow for this calculation? Well, we'll get to that in a minute. But I just wanted to notice that these results are pretty solid. The dividend yield is 5.2%, so we can expect 69 cents annually per every share. But the dividend changes a lot depending on the results of the company. That is why the dividend yield is not very helpful in this case. And the payout ratio? That is a check at 36%. And we want to see the payout ratio somewhere between 20 and 50%. So in this case, we know that we are getting a fair part of the earnings, and at the same time it is small enough that it will not slow the growth of the company in a big way. And what about dividend growth? It is a check at 30.9% 10-year growth rate. But also here, the results may be a little bit misleading because the dividends are all over the place, and we should not rely on this information as a good source for predicting future dividends. And it's worth noting that 2011 and 2021, when the dividends were exceptional, were the years when the price of iron was the highest. Right now, the price has fallen around 50% from the 2021 peak. So most probably, such great dividends are not coming back anytime soon. Like I said at the beginning, the PE ratio is 4.3, but it is a very simplified way of valuing a company. So we will use a discounted cash flow formula to find the intrinsic value of Vale. And for that, we will use a 5-year average free cash flow and not the recent one. Why? Well, the current free cash flow is much lower than the past ones, and this company is cyclical. So taking a 5-year average free cash flow should give us a more realistic view of the company. Thanks to that, we can isolate the short-term results and concentrate on the big picture. We will have to estimate the growth of Vale for the next 10 years, and we will make 3 different scenarios of the future. So, in the low scenario, we will estimate a decline of 5% for the first 5 years and then no growth. In the medium, a decline of 2% and then a growth of 3%, and in the high scenario, no growth for the first 5 years and then 5% growth. And we just saw that this is a very strong and healthy company. So why did I estimate a decline in low and medium scenarios and just small growth in the high scenario? Well, there are 2 reasons for that, and one of them is really important. So when we look at the company's growth in the last 10 years, we see that the revenue declined by 0.6%, free cash flow growth was 22.2%, and earnings per share went up by 14.3%. So apart from the revenue, everything else looks really great. So that does not explain my estimates. But this company's results are depending in a big way on the price of iron. And currently, it is around $110 per metric ton. But the long-term iron ore forecast predicts that in 2025, the price can drop to $80, in 2026 to $70, and in 2030 or 31, the price can be as low as $50. And of course, these are only predictions and they may be wrong. But if the general trend will be something like that, then that will have a very meaningful influence on the results of this company. So with these estimates, the intrinsic value in the low scenario is $18, in the medium $23, and in the high scenario $27. But we have to always add a margin of safety to those prices. I use a 30% one. And that allows me to be wrong with my estimates and still not get into any serious trouble. And with such a margin of safety, we get in the low scenario $13, in the medium $16, and in the high one $19. And the current price is around $14. So almost all the scenarios are in the green. This company is currently very nicely priced. And one of the main reasons for such a low price is the fact that the results depend on the price of iron, which most probably will go down substantially in the long term. So it may be a great investment, but it is important to understand that this is a cyclical business and that it most probably reached its high around a year ago. So when we are deciding if we should invest in this company or not, we have to take that into consideration and understand that not only the results of the company, but consequently the dividends are going to be influenced by this change in a big way. If you think I overlooked something significant in this analysis, please let me know. I really appreciate you sharing your ways of looking at companies, and I learn a lot that way as well. So thank you very much, and see you in the next one.